ideally, of course, in our ideal world, 3 pushes up or 3 impulse waves up. But if you're in something and it's making consolidation and it has a first down break against your position, even if you still have profits in the position, look to get out on that first pause. And you can keep it very, very simple like that. So that's what I want to do now, is go back down to a very basic model for S&P scalping, which we use in the markets, that I can show you, I can tell you in 5 minutes. And you can see it for yourself. It just takes a little practice, a little confidence, but I want you to understand conceptually what is going on. First of all, let me preface it by saying that with the S&Ps, I actually started trading them the very first day that they were listed. And I traded them when I was a floor trader on the floor in the equity options. We'd trade them on the side. I traded them as a CTA. When I first started trading this market, I was very much a counter-trend trader. And in those days, there wasn't much of a trend. We didn't have to worry about the big bull market of 95 and 96 and 97, clocking you out of the water. So I used to use the ticks a lot and wait till the ticks were overbought or oversold, go in with a counter-trend position, and trade it in that manner. And I used to chart the hourly cycles and look at the premium and some various other factors. And back to my study of technical analysis and all the things I have looked at in 19 years, and there's a lot of people that have been in the market much longer than I am, and they'll probably agree with what I'm going to say. I will tell you the easiest, cleanest, quickest pattern to trade. And that is a simple, small, little bull flag or bear flag. That is the simplest pattern that you can identify in the market, where you can go in and make the most amount of money in the least amount of time. It is a continuation pattern. In other words, we've already let the market break out and tell us the direction that is running. We're not geniuses here and picking bottoms or reversals or anything like that. We're looking for that first thrust up that tells us that there's somebody very anxious to get into this market. You'll get a small pullback, a small bull flag, and you will get a second leg up. Now you will see the small bull flag, bear flag. Sometimes it's a little triangle, sometimes it's a pause. You will see that on 1-minute charts, 5-minute charts, daily charts, weekly charts. You will see it on every single time frame. And if you can train yourself to be sensitive to that one little pattern, you don't need oscillators to look at it. You don't need to even look at the volume in the situation. You just want to make sure that the market is active, that there is volume, because one more thing that all these men, these forefathers of technical analysis said: don't trade in dull, quiet markets. Don't trade when there is no volume. It was very, very choppy a week or two ago in the S&Ps. The bid-ask spread was wide. There wasn't a whole lot of volume. And it was, you're just going to get chewed up back and forth on adverse slippage and bad execution. So wait till the market comes to life. And you can see in the last, forget today. The day was, I don't even know where we closed, but it wasn't choice trading this morning. But the day before and the day before that, you can start to see, once we get running, the small bull flags and bear flags that start to set up, the continuation patterns. All right? So think about that. Continuation pattern allows you a couple things. It allows you to limit your risk. You're going in the direction of the trend. The market's already moving. The only thing that it requires is for you to be on top of the market. Okay, they don't sit there and ring a bell and say, okay, we're going to hold it down here in this window for the next 20 minutes while you call your broker and futz around with the price. And usually, when I do my trading, I enter everything at the market. Everything. Buy at the market, and I exit at the market. Because when it's moving, you can't afford to miss that one good trade. And if I miss a little 5-point move in the S&Ps, think about all the bad execution that would pay for, and all the slippage. It's not bad on part of the brokers. It's just like times when the pit's, thin and you want it you want it badly enough, you pay up for it. And so that's sort of one thing that I subscribe to a little bit now. So this concept of entering on these small continuation patterns, what do we have here? We've got a basic chart pattern, all right? Small. It's a small chart pattern. It's not a big thing that we have to analyze and say, gee, is this big top here in the S&P for the last 2 or 3 months, is it going to come out the upside or the downside? You know, well, why don't I just go hit my head against a cinder block wall for 10 times and see if that feels good? You know, you don't know. You can't know. It's going to get in your way of making money today. And that's the concept I want to get down to, making money right now. The small continuation patterns will best serve you. Now, let's increase the odds that these continuation patterns are going to work. All you have to do is look at one higher time frame. That's it. One higher time frame. And let me explain why. If you are just working on a one-dimensional playing field, and let's say all you are doing is looking at a 5-minute S&P chart, and I keep on using the S&Ps because most people have looked at that market or desire to trade it at some point. If you're just looking at a 5-minute time frame, you don't understand, you don't see enough data of what's happened before. And let's say theoretically that you've just had a huge run-up, a huge markup on the hourly charts. Let's say you've had a run-up like we had, in the last 2-3 days where we've gone up a number of handles. Well, what's going to happen is that short-term time frame, you might get a little correction down or just a little blip. But there's so much support underneath. The momentum has been so strong. The impulse on the higher time frames is so strong that you might just be getting a little retest. In other words, you might be playing for a very small amount with not a lot of potential. In other words, I'm not saying that go and say that the daily trend is up, therefore I'm only going to buy hourly pullbacks, because that concept has its flaws too. But what I'm saying is just make sure that if you're buying on that hourly time frame, it's not right after you've had a huge downfall for 2 days and the market has to go back to that Wyckoff sequence of test, reaction, and there's not going to be a whole lot of play. You see? You see, it's like if that sugar market or cocoa or pick any market that's been falling out of bed and you see that huge price drop over a 2 to 3 day period, what's got to happen? The market's got to chop around and back and fill and back and fill. And you don't want to get sucked into playing the upside on a short-term time frame too soon. So that's all. It's just a filter. Use a higher time frame as a filter. So we've got our small continuation patterns. We've got a higher time frame as a filter. Okay? Our immediate objective is just looking for tests. Okay? Because if we've backed off a little bit, you run up, you have a bull flag, you make a high, maybe the S&P pulls back 3 or 4 points. We're just simply looking for a test. If it's a good trade, it will run deeper, and you'll get the benefit of some extra slippage in your favor. And then the last thing that's important, that I find important with watching these S&Ps, is almost every major turning point on the S&Ps, be it whether you're looking at a 5-minute time frame or an hourly chart, has some form of non-confirmation. And that's what I watch during the day. I'll watch the NASDAQ futures, I'll watch the Dow, I'll watch